following program sponsored by Adams Financial Concepts.
About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So it's Friday afternoon, and we're going to be talking about money. Now, if you've listened to the radio program very often, or read some of the blogs or some of the e-letters, you know that I have a wide range of reading material. I read every day. I read 3 daily newspapers. I go through 23 magazines, plus or minus. I don't remember anymore. I do 2 to 3 books a month and read a lot online. So it's all pulled together, and my wife thinks that I read crazy stuff. You know, I'll read something like The Grapes of Math, which is a book about math. Singularity, which is the concept that things are going faster and faster and that we're on an exponential growth curve rather than a straight line. Or predictive analysis, the use of big data to predict events and predict what's going on and who consumes what. And of course, the history of interest rates. 5,000 years of history about what interest rates have done. Really exciting stuff. And how about GDP? A Brief but Affectionate History by Diane Cole. GDP, a brief history. But some of that really applies. And there was an article in the Wall Street Journal that came out this week, came out on the 9th of August. Productivity falls and imperils growth. That falling productivity could imperil growth. And it got me to thinking about all these things in mathematics. You know, what the article pointed out is that we have been on the longest slide in productivity since the 1970s. The previous quarter that we were in, the second quarter, productivity was down 0.5%. That means it takes more man-hours to produce the same amount of goods. And the trend line is down. From the mid-2000s, from 2006, 2007, you have a trend line that was going from 3.5% productivity down to the last couple quarters, it's been negative. So is it true that we're actually losing productivity? I don't think so. I think it's not understanding what goes on. So productivity is very, very important. Let me give you 2 examples of productivity and the importance. One, I want to take you back to 1850. I've talked about this before. We were a country that depended upon agriculture. 23 million people in 1850, 11 million people worked on the farms. Agriculture was 64% of our GDP. Today, instead of 11 million, we're 150, 160 years later. Instead of 11 million, 50% of our population, we have 994,000 farmers. And instead of producing less than $1 billion worth of agriculture output, we produce 835 billion in agriculture. So we're producing over 600 times, 700 times what we produced in 1850, and we're doing it with less than 1% of the labor force. That's productivity. That's, it took a farmer with one of those scythes or whatever you call it, sickles. It took him a full day to cut 1/5 of an acre of wheat. Today, you have combines that cut the wheat and do the whole thing. They do acres and acres and acres in a day. That's productivity. We have tractors, we have combines, we have all those things. That's on the farming side. But if you look at manufacturing, 35% of the population worked in manufacturing in 1940. Today, less than 12% does. We're producing 15 times output of what we produced in 1940, and we're doing it with significantly fewer people. That's productivity, and that's what it means. And so when you have productivity, what that also means is as you gain productivity, you see wages grow in relation to that. That's why productivity is important. It's important to be competitive. It's important for increasing wages. And this whole period of time when we've been talking a couple decades and not seeing increases in wages, I think it isn't due to changes in productivity. It's due to a mix of workload. But that's another subject. So right now, this whole idea that productivity has been decreasing, I believe, is a false set of data. And usually I trust data a lot, what the government produces. But let me give you an example. You take computer memories, for example. There's a thing called Moore's Law, which says that you get twice the speed at half the cost every 2 years, or twice the amount of memory every 2 years, and it costs you half as much. So think about this. If one person working all year long produces 100,000 units of memory, and each unit costs $10, you're producing $1 million worth of output for one person working 2,000 hours. Or essentially, for $500, you're producing $500 an hour. $500 of output is what you're producing, that one person is producing. So try to follow me along. This is math. We'll get there. So assume that during the next 2 years you install some equipment, and that same guy can make, or woman, can make 150,000 units working the 2,000 hours. So that's a 50% increase in productivity. And if the price remained the same, you would have no gain. It would look as if you had a 50% gain in productivity because the price was the same. You get the same person producing 50% more. So it would look like you're producing $750 worth of output per hour instead of $500. But Moore's Law says it's going to cost half as much. So instead of costing $1.5 million, those 150,000 units are going to cost 750,000. Following the math, there'll be a quiz at the end of this whole program. Anyway, so you're producing 50% more, but the cost has shrunk by 50%. So what you get is $750,000 worth of output. You're getting twice as many units, and it looks as though productivity has declined by 25%. It looks as though productivity has declined by 25%, even though output is actually increased by 50%. Now that's an extreme example, but that's what I'm saying. That's what the numbers are missing. And that's what's going on today when we're dealing in disruptive change. You're going to hear from my guest today, and you want to hear from my guest because he's dealing in a disruptive area. He's dealing with something that can make dramatic changes in output and yet will reduce cost. It's one of the new things. You know, part of this program is to introduce you, the listener, to what's coming so that you're ahead of the curve instead of behind the curve. What they're doing is going to significantly increase productivity and reduce the cost. So it's almost going to look like productivity is in decline, even though it's increasing. You know, that's the same thing happening with GDP today. You hear that GDP is growing very, very slowly, that it's not enough for the economy. You hear that for the stock market has taken off, and yet the economy is growing slowly, and we need to do something to augment the economy. I'm not quite sure that that's the real answer. You know, Albert Einstein's insight said that no matter how, no matter where, no matter when, no matter by whom it was measured, the speed of light in a vacuum is constant. The speed of light in a vacuum is constant. That was what Albert Einstein found and contributed. But that's not been true of price. William Nordhaus of Yale calculated what it would be like if you looked at light and the cost of light in the same way we calculate GDP, because you would add the change in the price. If you looked at the time from 1800 to 1992, for example, the price of lighting increased 3 to 5 times. 3 to 5 times. So GDP would show that lights had increased 5 times, for example, or 3 times. But if you measure it by the lumens of light produced, it drops the price by 100-fold. By 100-fold. So the GDP is not picking up those changes in technology and changes in life. Now we're going to come up to a break in the program. If you missed this, you can find it on our website. Don't go away, because you also want to hear what my guest has to say, and I want to update you about what's going on in the oil market. That's also important. So right after this break, I'll be back, and we'll be talking a little more about GDP, as if that's not an exciting subject, I know. But it does have application for investors. Don't go away. Be right back.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
The answer.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I've been talking about productivity and GDP. And even though it's a boring thing, it has an implication for investors. Because if you misunderstand this, you can get so involved in backing off what's going on in the market, you can miss things that are going on. So it does have implications. And the numbers that we see need to be changed. So if you go back and think about GDP, it actually, I like history, so here we go. It goes back. GDP was developed not to measure business output, but in 1665, William Petty of the UK, England and Wales, wanted to estimate what the income and expenditures and population and land and assets were, because they needed to finance what would become the Anglo-Dutch War. And he wanted to know if they had the resources that they could finance it by raising taxes. That's why we ended up with the GDP to begin with. Were they able to finance a war? War had a big thing to play, because the most recent changes to the GDP happened in 1940 with John Maynard Keynes. And very similar way, once again it was war, this time World War II. And he wanted to know, what could the UK produce with their available resources to fight Germany? What resources could they mobilize for the conflict? And how would it affect consumers? How about the citizens of the country? How much would they be hurt? How much would they lose in terms of salary and income and resources in order to marshal those for the conflict that was with Germany? And he was very, very upset. Keynes was very upset because of the inadequacy of the data. So he set about to improve the data. But it's a thing that requires constant change. Products, when you think about it, in the 1970s, we started to see cars and radios and washing machines and refrigerators and TVs and cameras and lawnmowers and telephones. All those things were very limited in supply in 1940. Think about it. Those were durable goods, but the non-durable goods that came about in that time with fashion and music and restaurants, going out to eat, and the fast food restaurants, and moving besides special events to restaurant meals. That was something that happened in the 70s and the 80s. The term teenagers, I believe, was invented in the 1960s because teenagers were not a separate purchasing category before then. They became one in the 1960s. In 1950, 75% of Americans had washing machines, but it wouldn't be until 1970 in Europe before 75% of the population had washing machines. In 1960, 75% of the Americans had cars, but it would take a number of years before that happened in Europe. 1970, 94% of Americans had telephones, but in France and the UK, fewer than 50%. Today, think about how fast smartphones have penetrated the market. You think about it. This little smartphone that we carry around with so much computing power didn't really exist 20 years ago. The mobile phone was that big box thing. Tell people to carry that around. I mean, it was what? It was maybe 14 or 18 inches long. It weighed 10 or 12 pounds. That was far from something that fit into your pocket. And all it was a phone. It didn't have computing capability. It didn't have computer capability. Those things change. And like the example that I used before with light, if you measure just price increases in going from candles in 1800 to what the tungsten filament light bulbs we had in 1992, the GDP would show a 3 to 5 time growth in output, in increase in GDP. Whereas if you measure the number of lumens, if you measure the amount of light that is being produced, it's over 100-fold. That's one thing that doesn't happen in GDP numbers. Many countries, as we look around the emerging markets, and the emerging markets are going to drive the super cycle, I've talked about that, many countries have not changed their GDP calculations since 1968. There was a study of 45 countries, and 24 of them had no pricing data. They didn't know what the prices were within their country. When prices and weightings are changed and updated, there's going to be significant changes to world GDP. But it's something that we look at, we talk about, politicians talk about, but it's important for you to know that there's changes going on, technological changes, where productivity is being gained, where it looks as if it's being lost. GDP looks like it's growing slowly, where in fact, if you add the real changes that are taking place technology-wise, we're probably growing at a much more rapid rate. That won't show up until we do the next revision of GDP, which could be 2 years, 5 years, 10 years from now. Then suddenly the GDP numbers that we say were fairly slow will look like they're significantly above. One of the things that's going on, and part of this program is to introduce you, the listener, to being ahead of the curve, to understand what's coming, not what's gone on, but to be ahead of the curve so that you can be wise with your investments and be where things will be rather than where things used to be. And that's my guest today is Bob Berry from Envelop VR. He's got a very interesting story. It's something that is on the leading edge right now. And in my opinion, it's going to make a huge difference in productivity. Welcome to the program, Bob.
Oh, thanks, Mike. Nice to be here.
Why don't we start with your background?
Oh, my background's a complicated one. I was a high school dropout, went to work for an edutainment company making educational games for underprivileged kids. And I did while I was working in that industry, I was writing some academic papers with a friend of mine and ended up getting invited to Japan to do my PhD in virtual reality, which is what I was dabbling in. And so I moved there in 1998 to work on a PhD and found that VR in the 90s was pretty terrible. All we could do is make people sick at different speeds. And it was really just kind of an unpleasant environment.
And when you say VR, you're talking about virtual reality.
Yes. And so I kind of got disillusioned with it and went back to video games. And I've basically been doing video games for 25 years or so. And a couple of years ago, a friend of mine, after I said, I'm really thinking about doing something else for a while, and he said, well, why don't you come over to Valve, which is right in downtown Bellevue. Friends of mine at Valve said, come over and check out this VR stuff we're working on. This is like mid 2014. And I said, sure, I've done my share of VR work, but I'll come over and check it out. And I go into a room that's, the room is, covered in like these weird tags and stuff, like QR codes. And it was a hand-built, janky headset, held together with duct tape and stuff. But I put that on my face, and 20 minutes later, came out and told my business partner, we need to start a VR software company tomorrow, because it's finally here. And I always joke, virtual reality's been a technology that's been 10 years away for 40 years. It's always just around the corner. But the reality is it's actually here today. We finally have the hardware has matured enough to the point where I can safely say that it's here, and I'm willing to bet a company on it.
It is something that is here today.
Mm-hmm.
And I don't think very many people understand. Valve, of course, made the front page of the Seattle Times today with the gaming show, but they're just their focus is on gaming primarily.
Whereas, definitely. Most eyes are on entertainment and games for virtual reality because it is this fundamentally new medium, and it delivers an extremely compelling and personal experience. But our view is a little bit more macro in terms of we believe these new immersive technologies, and when I say immersive technologies, I mean virtual reality and augmented reality, which is like a Microsoft HoloLens. These provide a fundamentally new way for humans to interact with computers, data, and other humans. Much like you could liken it to the brick phone that you were talking about, where that was a new way for humans to communicate with each other, like be on the move and be able to communicate with another human anywhere in the world that's also on the move. That's a new form that we never really had before. So VR is the same thing, but to the nth degree. It's really fundamentally new. So
I want to back up and ask you for a real definition of what virtual reality is, so
Sure.
people have a picture.
So a virtual reality display is going to take over your entire view, right? So the current incarnations look almost like a ski mask. Ski goggles, right? And so your periphery is kind of blacked out, and we try to keep as much light out of the display as possible. And then you've effectively got two cell phone panels, or one cell phone panel, like an inch away from your eyes. But with some special optics and distortion and stuff, we can make it seem like this image is kind of surrounding you. And when you go into this experience, if the software is set up correctly and you have all the hardware components all aligned perfectly and everything, we can create what we call presence. We call it with a capital P, where your brain is actually buying into this virtual world that we're creating around you. You really believe that you've been transported to another place.
We're going to come back and talk about that other place right after this commercial break, so don't go away. This is something that's on the very leading edge. Believe me. We'll be right back.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I'm here with Bob Berry of Envelop VR. We're talking about virtual reality. And, I thought about this sometime. Back in the mid-90s, I was invited to speak to Rotary. And I asked Rotarians, there were maybe 150 or 160 people in the room. I asked, how many people have an email address? And maybe 6 people held up their hand. And I said, remember when people would ask you, do you have a fax? And now people don't ask, do you have a fax? They ask, what is your fax number? Because it's assumed that you have a fax. This was mid-90s. I said, with email, people will not ask, do you have an email address? They'll say, what is your email address? And that happens. I never foresaw that we were going to have 2 or 3 or 5 email addresses for everybody, but email address is there. And what I see here, virtual reality, it's in many cases, people talk about it for gaming and entertainment. I understand there's a company that's developed one with Kenny Chesney, so you can feel like you are part of the band. You can look at, you can see the whole thing. That's on the entertainment and gaming side. But what we're talking about today is something far beyond that, something that is going to have an impact on productivity and GDP. So anyway, back to my guest.
But it's funny you mentioned that because I was just at the Seattle Technology Leadership Summit a couple months ago, and the question was posed to the audience of about 1,000 technology leaders in the area. How many people have tried virtual reality? And there might have been a dozen hands, 20 hands that went up. And it stunned me because, you see billions of dollars being invested in this ecosystem right now that, the greater Seattle area being a hotbed of a lot of this virtual reality development, you would have expected more hands to go up. But it's inevitable.
It's inevitable. But we're at the very cutting edge.
Yes.
And there'll be companies that rise from nothing, and there'll be companies that actually die as well. But anyway, let's talk about what you're doing, because you're focusing not on entertainment or games. You're on the business side.
Well, we look at these technologies as a fundamental new computing platform, just as fundamental as the internet itself or mobile. And you could go all the way back to mainframes. And effectively, what it allows us to do, like the same technology that allows us to transport you to some fantasy world or sci-fi world is the same technology that allows you to experience data in a way that your brain is actually wired to experience it. So as an example, if I was designing, a car part, and I'm working for some auto manufacturer and I'm on the design line, when I'm looking at a 3D object that's been flattened onto a 2D screen, even if I have mouse control and I can rotate this object around on the screen, my brain is still doing mental gymnastics, trying to reason about this 3D thing that I'm creating, because I don't have really the depth, that I would normally experience if I had it in my hands, where my eyes are darting around to get extra information about it, or my head is just slightly moving to get, more of the sense of the 3D-ness of the object. Well, in virtual reality, we can actually put data in front of you in a way that, basically is formatted for your brain. I mean, in VR, I can look at a virtual object and I can look around it, and I can stick my face into it, your head is the camera. It is the natural way that you're supposed to experience a 3D object. And so that leads to a greater intuitiveness about the object, and you're able to reason about it more efficiently. And in doing so, you, like in manufacturing, for example, you can catch errors, before they happen. And we've seen this in a number of cases in some of our enterprise studies where we've had engineers tell us, if I could have just seen that in VR for 90 seconds, I would have known instantly that the scale was off. Like ergonomically, a welder would have to crouch down at this jig, and that's just all wrong. It's like 6 inches too small. Had I known that, I would not have manufactured and installed 230 of these jigs across the different assembly plants that I'm now going around ripping out, right? So the idea here is that, a single, head-mounted display, virtual reality display, inserted into an enterprise at the right place in the workflow at the right time can have a profound impact on a business and save it a lot of money and increase output.
I know when I was at Envelop this week and looked at that and had the headset on and looked at it, you can actually, your brain thinks that you're actually there, that the part is really in 3 dimensions. You can increase the size, you can twist it around and all sorts of things. You can inspect it from every angle. And it has to be a tremendous labor savings when you're building something like an automobile or an airplane or something that's fairly complicated. Even you take the cell phone and all the components that go into it. And as we become more and more toward nanotechnology, I mean, instead of looking at something through a microscope, you're going to be able to see it virtually and blow it up.
Oh, yeah.
So that you can actually manipulate something that's microns of an inch and see it exploded 100,000 times, so you can see all the little things that are involved.
Yeah, and with immersive technology, your body is the input into the system. So what we're entering is this like symbiotic age with computers. If you think in terms of back in the mainframe days, how long did it take you to ask the computer a question, and how long did it take to get a response, right? We could measure that in terms of hours or days. If my punch cards were wrong, I didn't get an answer from the computer, and I had to go back and redo my punch cards and put them back in. I'm not old enough to have done that, but
I did. I did.
Right. But hours and days for that. Now I've got my iPhone next to me, and I can ask Siri, what was the score of the game today? And I get answers back within seconds, right? So that round trip time from me asking the computer a question and me getting a response is very quick. But in virtual reality, this is a whole new order of magnitude faster, right? We measured the response time not in seconds, we measured in milliseconds, right? And we call it motion to photon latency. My movement, my head, when I move my head a certain way, I'm asking the computer, what does the world look like from this position? That's a question. And the computer has 20 milliseconds at most to give me a response. And if we don't hit 20 milliseconds, you get nauseous. So the stakes are really high too. But that idea there is that we have a very intimate form of connection with the computer when you're in virtual reality.
So I had a question, and then I've forgotten the question. I got so involved in this virtual discussion. Virtual reality as opposed to augmented reality.
Yeah.
People talk about those two areas.
Yes, and there are others, for example, like Google Glass, which a lot of people mistaken for virtual or augmented reality. Google themselves will say, no, this is assisted reality, right? I've got a little heads-up display in my periphery that's going to give me some extra information about maybe something that I'm working on, which is a very good use case on its own. But traditionally defined, virtual reality, as we discussed in the previous segment, was, I'm going to take over your entire display and I'm going to transport you to another world. Augmented reality, on the other hand, is you're going to experience the physical world, and we're going to overlay virtual objects, and we're going to anchor them to places in the physical world, and we're going to anchor them so well. Like I could put a little elf, sitting on the edge of this table with his little legs dangling off of it, and he's going to be anchored there virtually so well that when I look around him, I'm just going to kind of believe he's there because it's so solid. Like the system makes you believe, your brain buys into it being there because you're getting all the right informational cues when you look around this object. It looks like it's there. But a lot of people place a huge distinction between virtual reality and augmented reality because today the technology that drives those are very different. The display technologies are very different. But ultimately they're going to converge, and we will have one display device that can do both augmented reality and virtual reality. But it's not an either and or. Like if you think of it in terms of a spectrum of opacity, how opaque is my display? In virtual reality, it's 100% opaque. I'm gonna take over your entire view and transport you to another world. In augmented reality, we might have, well, it's mostly transparent. It's mostly the real world, but we're just going to put a couple of little virtual objects. But it's a spectrum. It's a spectrum of opacity, and there are many different use cases all along. I might walk into an unfinished construction site and go into a particular augmented reality mode. Maybe that's halfway, where I'm getting most of the completed building as my augmented reality. But I still have maybe some certain walls exposed and things like that, and I can see through them. We're only just starting to scratch the surface of what are all these use cases at different levels of opacity.
I want to finish quickly because we're coming to commercial break. You have organized a conference.
Yes.
Can you tell us quickly about the conference?
It is called the Immerse Summit. It's going to take place in downtown Bellevue. It's October 11th, I believe. And it is meant to be to raise awareness in our local business community about immersive technologies such as virtual reality, augmented reality, but all the periphery technologies too, like natural language processing and haptics and stuff. And it's going to be a fantastic event, and we'll have a lot of incredible exhibits, some great speakers, and some great keynotes.
So, if the listener needs to become knowledgeable about this, and I would recommend that everyone do, it's well worth attending the conference.
Absolutely, yes.
Well, thanks for being on the program, Bob.
Thank you very much. It's been
really
fun.
On the cutting edge. Thanks for being here. We're going to come up to commercial break, and then I will be back to update you on what's going on with oil. It is unfolding almost as we predicted. So don't go away. I'll be right back.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and, probably most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today 206-903-1019 or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
Your business leader for Seattle is 1300 KKOL.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So in 1973, we had OPEC, which initiated the oil embargo. And it was something that I've talked about before. The initial price increases were backdoor negotiations between Nixon, Kissinger, and the Shah of Iran. But by 1973, it became OPEC's thing to raise prices and to limit the amount of oil to push prices up. And what happened is we ended up with prices jumping up, inflation took off, we had economic havoc taking place. In 1986, what we had was the opposite. We had an oil glut with the price of oil slumping all the way to $10 a barrel. The economy took off and things grew. You know, right now we have oil prices down 50 to 75%, and a number of people, soothsayers, market strategists, saying that we're going to experience, or we are experiencing, a recession or a depression. One of the things that I like to quote is Jason Zweig, who wrote a book called The Devil's Financial Dictionary, and he defined a market strategist as a direct intellectual descendant of the ancient Roman official known as the haruspics, who were practiced in the Etruscan art of divining the future by inspecting the livers of sacrificial sheep and chickens. The typical market strategist uses methods similar to those of a haruspics, but less accurate. However, the modern market strategist has a much higher social status and earns vastly greater income than a haruspics, even after adjusting for more than 2,000 years of inflation. That was how he defined it. And I believe we're living in a time where the pessimists are wrong and they're looking at the wrong livers. You know, I believe it's really a function of economics 101, supply and demand. When the supply goes down, prices go up. When demand goes down, prices go down. It's supply and demand. If demand is greater than supply, you see prices rise. If supply is greater than demand, you see prices fall. And what the pessimists are seeing is that prices are dropping. And usually what that's interpreted, when oil prices are dropping, when commodity prices are dropping, it means they're interpreting that as being demand is falling off. Things are slowing down. You have X amount of supply because you know that once you begin those oil wells pumping, they're pumping out a certain amount. And if demand drops down, price is going to drop down. And in the past, that's what it's meant. Demand dropping down. And if demand is going down, you're headed for or in a recession. Now, you know, listening to some of the people on CNBC and reading some of the articles and papers, some people believe we're already in a recession, and some believe that we're headed for a Great Depression, even worse than the Great Recession we just experienced. I don't think they're right at all. China's economy is slowing down, yes, but in 2015 it was growing at 6.9% versus 7.3% in 2014. This year it's slowed down a little more, but it's still growing. It's not going backwards. Most of the world is not going backwards. China's oil consumption set a new record in the fourth quarter of 2015, also a new record in the first quarter and the second quarter. It's slowed down. It's not growing as fast, but it's still growing, and they're still consuming more oil now than they consumed when the prices began to drop. If you look at what's happened, it's a matter of too much supply. If you look at world oil consumption, in 2010, we were consuming 88.2 million barrels per day. By 2015, that had grown to 94.5 billion barrels. And this year, it's estimated it'll be somewhere between 95.7 to 96 million barrels per oil per day. Now, that's an increase. That's not demand falling off. That's actually an increase. And in 2017, it's expected to be 97.5. It's increasing about 1.2 to 1.3 million barrels per day every year. It's not demand increasing. World GDP is growing. But what has happened, is supply got overblown. If you look at just some of the expansions of what was going on, almost $6 trillion went in increasing oil supply in the last few years. $6 trillion. And that's just in North Dakota, that area off the coast of Brazil, and in the outback in Australia. $6 trillion of expansion. Plus, you had the fracking that took off in the U.S. It was a huge augmentation of the amount of supply without the same increase in demand. And when you have too much supply, and even if demand is growing, prices come down. And that's what happened with oil. That's what kept oil prices down. If you look, however, the impact of that, and early this year I said that the impact was we were going to see a number of companies file for bankruptcy. That's happening. For 94% of the oil producers, a price of $30 per barrel is enough to pay day-to-day operations, but it's not enough to pay the overhead or the interest on the debt, pay off the debt, or all those extra things that you have to make payment for. $30 keeps you operating, but that's all. You need $60 per barrel to be decently healthy for most producers. We're under that 60. We're above the 30, so some are making progress, but we're under the $60 per barrel. And what's happened over the first half of this year, 90 oil and gas producers worth an estimated $66.5 billion have filed either for Chapter 7 or Chapter 11 bankruptcy. Chapter 11 means reorganization. They want to reorganize the debt. They want to reorganize and come out the other side and be a continuing company of production. Also, 44 exploration and producers worth an estimated $25.5 billion have filed for bankruptcy. If you look at worldwide what's happening, the OPEC countries are increasing production even though there's an excess capacity. And yet it's a lot of the U.S. and other countries that are reducing capacity. Comparing this year to last year, 750,000 barrels per day have been reduced in total production. So we're reducing, companies are filing for bankruptcy, companies are going out of business. We have not yet started to reduce the inventories. So it's going to be 2017, maybe even into 2018 before we get rid of a lot of the excess capacity and overhead supply before we really get back to a $60 per barrel oil price. So it says something about that type of industry. It impacts the capital expenditures, but it also says something about a positive growth in the economy. It's positive in the long term for the economy. Negative for those oil-producing sectors of the economy, mining sectors, but positive for the economy in general. Some advice for investing. Anyway, that wraps it up for today. Have a very good weekend, and next Friday I'll be back with more insight so that you can stay ahead of the market. Have a great weekend and a great week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only. Any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Your business leader for Seattle is 1300 KKOL.